When a partner retires or dies, partnerships often keep making payments. Here's the exam trick. Those payments are generally treated as partnership distributions, not as guaranteed payments, and not as a separate distributive share item. That matters because distributions usually aren't immediately taxable unless cash exceeds outside basis. On the EA exam, they love asking you to classify the payment first before you do any math. A retiring partner or a deceased partner's estate is treated as a partner until the interest is completely liquidated, so you don't stop allocations just because someone died or walked away. Practically, that means the partner or estate can still receive allocations and distributions during the wind-down period. The key phrase to remember is treated as a partner until liquidation. That line shows up constantly in partnership questions. Death does something special to the partnership tax year. It closes the partnership's tax year for the deceased partner, but it generally does not close the partnership's tax year for everyone else. So the partnership issues a final Schedule K-1 to the deceased partner, allocating income through the date of death. After that date, the successor, like an heir or estate, gets the remaining allocation on their own K-1. Use the John and Amy example to picture it. John dies August 1st. His share of ordinary income through August 1st is reported on John's final Form 1040 using the final K-1. The partnership's full-year share might be higher, but only the pre-death portion goes to John. The remaining portion after August 1st is allocated to Amy, who inherited the interest and stepped into his role. Now layer in a buy-sell agreement. That's a contract requiring the partnership to buy out a deceased partner's interest so the business can keep operating. For tax treatment, the payout to the estate is treated as a distribution. It's not magically salary, and it's not a separate guaranteed payment just because it's written into a contract. After the buyout, the deceased partner's interest is gone, and the remaining partner's percentages increase proportionately. One more exam connection. Distributions can create gain only when cash distributed exceeds the partner's outside basis. Property distributions generally carry over partnership basis, but the partner's basis in distributed property can be limited by the partner's remaining outside basis. So classification drives everything: distribution rules, basis reduction, and whether you recognize gain or loss. If you mislabel it as a guaranteed payment, you'll get the whole question wrong. Which type of income earned by a partner is not considered earnings from self-employment? The choices include guaranteed payments to general partners for use of capital, the partner's distributive share of interest income, guaranteed payments to limited partners for services, and the partner's distributive share of ordinary income. Think about which item is portfolio-type income versus business income. The correct answer is the partner's distributive share of interest income from the partnership. Interest is generally portfolio income, not self-employment earnings. A tempting wrong answer is guaranteed payments for use of capital, because it sounds investment-like. But guaranteed payments are generally treated as self-employment income to the recipient in these exam-style questions. When a partnership distributes property to a partner, what happens to the partner's holding period for that property? The options include starting fresh on the distribution date, tacking on the partnership's holding period, using the partner's ownership period in the partnership, or not including the partnership's holding period. Think about the general tacking concept for non-recognition type transfers. The correct answer is that the partner's holding period generally includes the period the property was held by the partnership. In other words, it tacks on. The tempting wrong answer is that it starts on the distribution date, because that's common in normal purchases, but partnership distributions typically carry over holding period along with other carryover concepts.